All right, let's talk about something that feels, well, completely backwards. What if I told you that following a mathematically perfect, optimal strategy could actually be the fastest way to go completely broke? Sounds weird, right? But that's exactly the paradox we're going to unravel today.
So Nassim Taleb has this incredible quote. It says, if you gave an investor tomorrow's news, they'd still go bust within a year. Now, how could that possibly be true? Perfect information should make you rich. But what it really gets at is this. Having an edge, even a perfect one, isn't the whole story. Not even close. It's how you manage your risk that determines whether you win or lose the game.
Okay, so let's start with this really tempting idea. The idea that there might be one single perfect formula out there to tell us exactly how much risk we should be taking.
To make this real, imagine a simple game. I give you a special coin, one that's biased in your favor. It lands on heads 60% of the time. Every time you bet on heads and win, I pay you even money. So the big question is, to make the absolute most money over the long haul, what percentage of your bankroll should you bet on each flip? Seriously, think about it for a second. Do you bet small and safe, or do you go big because you have an edge?
Well, believe it or not, there's a famous mathematical answer to this exact puzzle. It's called the Kelly Criterion. It was developed by this genius scientist at Bell Labs, and it's a formula designed to do one very specific thing: tell you the precise bet size that will maximize the long-term growth rate of your capital.
So, just to be super clear, here's the setup for our game. A 60% chance to win, 40% chance to lose. You win, you double your bet, you lose, it's gone. Simple enough? So what does the magic formula tell us to do? The answer is 20%. According to the Kelly Criterion, the mathematically perfect strategy is to bet exactly 20% of your current wealth on heads, every single time. Not 19%, not 21, 20. This is supposed to be the key to maximizing your growth. But, and this is a huge but, here's where the beautiful math runs smack into messy human reality. When researchers actually had people play this exact game in a study, a shocking 28% of them went completely broke, wiped out. Another third ended up with less money than they started with. So, if 20% is the optimal bet, why on earth did so many people fail so badly?
And this brings us to the hidden price of being optimal. It turns out the journey you take can be absolutely brutal. This is the reality of something called path dependence. Path dependence is just a fancy way of saying the sequence of your wins and losses matters. A lot. Even with a 60% edge, you can still hit a nasty streak of tails just by pure chance. 5, 6, 7 losses in a row. Now, if you're betting an aggressive 20% of your money each time, a bad run of luck right at the start can knock you out of the game before your 60% edge ever gets a chance to work. The journey can end before you ever reach the destination.
And that journey, it is filled with what investors call drawdowns. These are those gut-wrenching drops from your peak capital down to a new low. And let me tell you, these aren't just numbers on a chart. They are psychologically terrifying events that make it almost impossible to stick with a strategy, no matter how great it looks on paper.
And how bad can these drawdowns get? Well, if you follow that perfect full Kelly strategy, the math shows you have a 50% chance of, at some point, losing half your money. Let that sink in. A coin flip's chance of watching your account get cut in half. How many people do you know who could actually stomach that and just keep placing bets? Not many.
This is a brilliant way to think about the role of luck. Imagine 1,000 people, all starting with the same amount of money, all following the exact same optimal 20% rule. At the end, do they all have the same amount of money? Not a chance. Their final results would look like a giant cloud. A few super lucky people would have insane astronomical returns, which pulls the average outcome way up. But the experience of the median person, the typical person in the middle of the pack, would be much, much lower. Randomness just blows the outcomes apart. So if betting the optimal amount is just too painful and too risky for us mere mortals, what's the answer? Well, this brings us to a really powerful idea. When it comes to risk, less is very often more. Let's talk about the power of what's known as fractional Kelly.
So why bet less? Well, it really boils down to 3 big reasons. First, uncertainty. I mean, what if you're just wrong? What if you thought you had a 60% edge, but it's really only 55%? Overbetting when you're wrong is catastrophic. Underbetting is just a missed opportunity. Second, there's the risk of ruin from some black swan event, something totally unpredictable that no formula can ever account for. And third, and maybe this is the most important one, we're human. We are not robots.
We feel the pain of a loss way, way more than we feel the joy of a gain. Okay, so check out this trade-off. This is where it gets really powerful. Let's say you just cut that optimal bet in half. You bet 10% instead of 20%. It's a strategy called half Kelly. Look what happens. Your probability of suffering that terrifying 50% drawdown, it plummets. From 50% all the way down to just 12.5%. That is a massive, massive reduction in risk.
All right, so you're thinking, what's the catch? What do I give up for all that safety? And the answer is, surprisingly little. By cutting your bet in half, you only give up 25% of your potential long-term growth rate. You still get 75% of the optimal growth.
And that's the whole point, right there. It's this incredibly powerful, lopsided trade-off. You give up a little bit of theoretical, on-paper growth, and in exchange you get a huge increase in real-world safety and peace of mind. You make the journey tolerable, which means you're much more likely to actually stick around and finish it.
So this brings us to our final section, building a real framework for survival. It's not about finding some single magic number. It's about creating a rational risk policy that actually works for you.
So, let's just quickly recap the big ideas from all this. First, think of a formula like the Kelly Criterion not as a target to hit, but as a speed limit, an absolute upper bound on how much risk you should even consider. Second, path dependence is real. The bumps along the road are what you actually experience, and they can easily scare you out of a winning game. Third, deliberately betting smaller, using a fractional Kelly approach, is an incredibly powerful tool for managing not just the numbers, but your own emotions. And finally, the most rational, most intelligent risk policy in the world is simply the one you can actually stick with, through thick and thin.
Because in the end, the real goal isn't just to win the game. It's to stay in the game long enough for your edge to even matter. And that leaves us with one final question. It's not for a formula to answer, but for you. What level of drawdown, what level of financial and psychological pain can you truly survive and still stick to your plan? Answering that question honestly, that's the first step to building a risk policy that isn't just optimal on paper, but is truly optimal for you.